Okay, now to four small cap names to watch out for, and our next guest will talk us through how to buy and what to hold. Michael Goldberg from Collins Street Asset Management. Michael, a very good morning to you. Let's just get a broader picture at the moment. Obviously, not a lot to go on given what we've seen overseas with the markets closed, but how are you looking at it as we enter the final month of the financial year?
Look, I think our view is always that you've got to be bottom up, you've got to be company specific, and I think your last two guests who had broader views on the markets and sectors are clearly much cleverer than I am. I think it's a bit of a fallacy that people drastically transform their portfolios in the lead up to the end of the financial year, and perhaps there is some tax gain selling and some tax loss selling, but I think all in all, our goal as always is just to try and find those unique and good companies trading at attractive prices. And as far as what else is going in the rest of the world, we're not so concerned.
So, what have you uncovered either lately or what you're still pretty committed to in the small cap space as one of those interesting undervalued companies?
Yeah, I think one of the contrarian ideas that we've invested in, and we really started looking at it about 12 months ago, is a company called Boom Logistics, code BOL. They're essentially Australia's largest crane hire company, and they've got a national footprint. They've got exposure to things like resources, not surprisingly. They've got exposure to energy and renewables. They've got exposure to telecom and infrastructure and industrial maintenance. And over the last few years, I see your chart there is more recent, but over the last few years, they've actually gone from about 45 cents down to as low as 7 cents. In the last 12 months or so, they've been as low as about 10 cents, as high as 19 cents. And they've come back in the last couple of months to 13, 14 cents. So, as I said, we've liked this company for quite some time. It's coming up to about a year since we first bought it, and we first bought it at about 10 cents. We took a substantial position straight away. We own 10% of that company, so we obviously do like it. We're backing it with our money. In the pullback from 19 cents back recently to 13 cents, you'll see yesterday we actually made a ASX announcement that we've increased our position to almost 12%. We think this business is probably worth about 30 cents on the parts. You look at its NTA of 27 cents, you look at its free cash flows, which are somewhat confused by depreciation, but if you get to the bottom of it, you see the free cash flow is like $15 million per year, which is about 3.5 cents per share. They've only got $14 million worth of debt, so they could pay that off with 1 year's cash flows if they wanted to. And they're winning contracts from the likes of BHP and GE and the like. So there's a lot to like about this business, but at the same time, we do understand why the market and investors are hesitant.
All right, let's move to your next recommendation, Decimal Group. This is a construction contracting service company. And I noticed, in fact, they recently secured a $25 million contract to upgrade the stretch of the Bruce Highway. So what upside are you seeing in this stock?
Yeah, look, this is a wonderful business. They've come off some hard times the last couple of years. They recapitalized just on this side of the COVID crash. And they're really in that sort of weird position at the moment where the energy and excitement of the reorganizing and the refocusing of the business is sort of wearing off, and they haven't yet started kicking those goals. So we speak with Dickie, the CEO, and Peter, his right-hand man, quite regularly, and we're quite happy with the way they're approaching things. They're winning business, as you pointed out. They're growing their business, as you pointed out, and they're obviously in a wonderful space at the moment, given the tremendous amount of infrastructure spending that we're going to see over the next couple of years, both from the federal government and from the state governments. Again, they've got exposure across, much like Boom Logistics, across the entire nation, so they do have good diversified exposure. I think the challenge for them will be that they need to come to terms with their banks at the moment. The larger they go, the more business they win, the more they need to shore up their capital. So I understand they're in conversations with their bankers at the moment, and I think the market's probably just holding its breath, waiting in anticipation to see them get that capital shored up so they can really take advantage of the new flow of business that's likely to come down the pike in the next 12, 24, 36 months or so. So okay. Yeah, it's a wonderful little business with some excellent prospects going forward.
All right, I think we're losing a connection. We just persist. Let's turn to your sell, Coronado Resources. Now, in fact, we spoke to them last week. They deal with metallurgical coal, and they're seeing a lot of upside. particularly with as the world economy reopens, that need for energy. So what negatives are you seeing, or is this more a longer term play for you?
Look, I mean, we liked Coronado. We bought quite a substantial position for ourselves, maybe 9 months or so or thereabouts. We made the call that it's not really an energy play per se. It's not thermal coal that's their focus. It's metallurgical coal, which is a key ingredient that goes into steel. And our view was there's a bit of a disconnect between the price of steel and the price of iron ore relative to the price of metallurgical coal. And so we made an investment in it. Now, we had been aware that obviously there was a risk that China might implement restrictions on Australian goods because they'd already done it to other goods. We didn't think it was going to be a substantial issue for Coronado specifically, because even though they've got mines in Australia and obviously have met coal coming out of Australia, they've also got mines out of the US, and they actually don't sell to China. What we underestimated was the impact of China actually coming down with that decision, and the way that Australian coal would then flood the entire world. So even though Coronado wasn't selling directly to China, well, now they're competing with all the other people who were selling to China, selling into India or selling into America or selling to wherever the case may be. So it obviously got affected more than we anticipated. But what really bothered us was the capital raising that they announced. And I understand companies need to go into the market and they need to raise capital, and that's fair enough. But as far as we're concerned, one of the main jobs of management is capital management. And to have seen management go to the market 3 times in 18 months to do capital raisings, that's really, really disappointing. The other point that we noted was that despite the fact they were raising some $450 million through the capital raising in the market and also through some debt financing, at the same time they were giving up some of their debt financing from some of the major financiers. So their actual cash runway didn't increase. So we have some concerns that they might need to go back to market again in 12 months' time. We've got some concerns that, despite the fact that Australian coal prices have improved, and so the share price of Coronado has improved as well, when a company is so willing to go to market so quickly, 3 times in 18 months, that's something that we don't want to really be invested in. So
I do remember. You've made the decision to sell out. I remember you talking about Coronado Coal, so everybody reserves the right to change their mind. Listen, Michael, thank you so much. It's always a good chat, and we look forward to speaking soon.
No worries, Nadine. Thanks, Andrew.
Michael Goldberg from Collins Street Asset Management.